Hi, this is Chris with Home Garden Mortgages. It's April 11th, time for our weekly mortgage update. And what a week it's been. It's been one crazy wild ride. We had the Trump tariffs come in last Thursday, the retaliatory tariffs by China and the other countries on Friday, and rates plummeted to a 6 month low at 5.9. And essentially, as we explained last week, it's this flight to safety from stocks because there's uncertainty caused in the markets because we don't know what the impact of the tariffs are. So there's a flight to safety where investors sell stocks, they move into bonds. And as they move into bonds, bond prices go up, and inversely related are yields and rates. And so rates fell. And we were able to lock in a 5.9 on a 30 year for one of our clients without paying any points. Phenomenal rate. And that's where the expertise of working with a mortgage lender that actually understands the market, is able to time the market, comes in. So coming back to this week, uh, we are today at 6.875, so 6.9. So almost a point from last Friday. And one of the major reasons is because of the unwind of this basis trade. It's a hedge fund levered trade that basically uses the arbitrage between a cash position and a futures contract. So take gold as an example. It would be basically using the arbitrage or the spread between the cash price today and the futures price, let's say 1 month out. Uh, but because of the leverage that they're using, which is just a fancy term for borrowing and using other people's money, between 20 to 50x is the estimate that we have. Imagine if the trade goes against you and it's a 5% drop, right? So it decreases by 5%, the commodity price. The 20x leverage, 5 times 20 is 100%. That means it's wiped out your whole position, right? It's 100% loss. So when this happens, usually the bank or the investment brokerage that these trades are with will put a margin call on these hedge funds. And when they put a margin call, these hedge funds have to post back collateral. Now, collateral, like it looks like they're posting up, is treasuries, and the 10-year treasury to be specific, which has basically caused a lot of supply on the market for these 10-year treasuries, which in my previous example, there's a lot of supply, the bond prices, which treasury prices, fall, and interest rates and yields rise up again. Right. So this is the complete opposite logic of what happened last Friday, is what we're seeing unwinding this week. We think it's going to be a couple of weeks before this trade is completely unwound and tariffs kind of, take a back seat, and market forces, inflation, employment kind of, take a front seat and drive yields and rates again. But to put this into context, it's super important if you're a home buyer, if you're looking to refinance, to work with someone who understands, these market forces and what's really going on, right? Half a point, we always come back to that example. Half a point, we are based out of Cranford. The average price is 700,000. The difference in half a point would be from 700 to 735. You could go up 35,000 keeping the same mortgage payment. If you basically have a lower payment or a lower interest rate rather, you're essentially gonna save a car payment's worth, right? So shop around for the best rate. We've got all our rates on our website. The link's gonna be somewhere below. And I hope to see you guys next weekend.